a lot of the banks, like Bank of New York Mellon has, which is a wealth management bank, has a huge position in life insurance. And they're using this really for the balance sheet and for the guarantees and the death benefit that comes to the bank and so on. So yeah, so the truth of the matter is that the banks, although they're really horrible at selling it, they actually, for their own account, they buy it all the time. And that's still true to this day. And what has happened, though, guys, is that you used to be able to pull these call reports down. Now it's getting much more difficult to get to the truth, but it's still happening today. So I'm verifying this in the next book, but yeah, it's still true, but it's getting a lot harder to figure this out.
Now, Barry, I don't know if I heard this from one of your many books or listened to you on a podcast, but you had mentioned, or you did some research on where the Federal Reserve or the chairman and people that are the individuals actively in the Federal Reserve, what are they doing for retirement?
Well, that was the whole thing. This is the funny thing is that, we know that, 401k, I always tell people 401k stuff with mutual, I always tell people a toaster from Walmart has more guarantees than a 401k. So which is true. So the whole thing is so many moving parts. And so a 401k really guarantees nothing. They can put it through legalese, disclosure and arbitration, the whole thing. But the whole fact of the matter is that 401k with mutual funds or ETFs, for that matter, it has no guarantees. But you're getting back to the Fed, though, is that this is what I discovered. And this is how I get my foot in the door of Bloomberg, which I never, but I discovered the Bloomberg because I had the audit that the Federal Reserve 401k plan had 75% of its assets. It's 401k. This is all verifiable. I got the Deloitte audit. You have, Cameron, you have the book there, right?
I do.
Yeah. Well, so that's the audit's in the back of the book there. No, the other one, the guaranteed income. Yeah. So it's in there. So it's in that book. People go to barrydyke.com. So I verified it, and this is how I get to speak to Bloomberg. By the way, I said, guys, 75% of the Federal Reserve, which is the largest central bank in the world, which also has more economists, more PhD economists, roughly 400 highly paid economists under one roof, and they had 75% of their money in fixed annuities in their retirement plan. So this is kind of the craziness of it all, and this is how a lot of corporate deferred comp plans work. They're actually guaranteed annuities. They may be backed by the balance sheet, but they work as an annuity.
So, Barry, what I'm hearing is if we look at people who probably are the best or understand money, or the best are going to be banks and the Federal Reserves and these economists.
Yeah.
But both of them have a high amount of their assets in cash value life insurance.
Cash value life insurance and conservative strategies, guys, too. Not just in cash value. I mean, because they can't put it all. It'd be stupid for them to put it all in, and they don't do that. But they're very conservative in their strategies. And this is why I had to revise the book. So I actually went to the Federal Reserve, how they structure like their pension plans and things like that. They're all guaranteed annuities, which is a life insurance is an annuity. Well, I mean, through via 1035 exchange. So. But yeah, that's what you find is that, and then a pension is an annuity, and so what you find is that they're all taking these very conservative approaches. Now they'll gamble with your money, but for their own money they don't. No. Yeah. So I'll give you a great example. Morgan Stanley, which is they make 70% of their income from gambling with other people's money. You know how much they have in their own retirement plan in their pension plan in stocks and derivatives and junk bonds? And again,
very little.
80-20 probably, right? Isn't that one of the rules that they say, 80-20?
Would you say, Cameron?
5%.
I would say 80% because that's what they tell us to do with our money.
0.
They have 99% of their defined benefit plan. And this is, again, I got this from public records, from the summary plan description. They have 99% of their money into high quality fixed income. They don't even have any money in junk bonds.
Wow.
So this is the whole thing. So this is what you're seeing, and it's not just other institutions to do it. This is why I have to do the book. So Merrill Lynch, has annuities, and there are all these other institutions have them all the time, and actually the banks buy all this stuff too. So it's do as I say, not as I do. We'll get gamble with your money, but for us, we don't want any risk.
You want to see the entire episode? Click here. If you want to learn how investors use infinite banking to increase their returns and lower their taxes, click here. If you want to see if infinite banking is for you and you have some questions, hop on a discovery call with us and one of our coaches. The link for that will be in the description.